Welcome to the weekly video update, where we'll go over the action in the market for May 31st, ending on June 3rd, and then we'll look at the week ahead through June 6th through June 10th. Going back over the week's session, the S&P could not extend its gains from the previous week. If you recall, the week before was a pretty solid up week, and it looked like things were really starting to improve. But the concerns about the economic outlook, we're seeing some slowdowns in some of our economic reports. Earnings are causing some problems, specifically with some really big companies like Microsoft. They came out with a warning this past week. And then monetary policy from the Fed. It looked like a week ago that maybe the Fed was willing to pause their interest rates coming up this fall. Those statements were made by FOMC members, but not necessarily by Chairman Powell. Since that time, those statements about a pause in interest rates have been walked back, and that's adding a little bit more negativity to the markets right now. Oil prices rose for the week and actually got above 120, but ended up settling at a much lower price of 119. But still, these prices are really high, and I have some charts later to show you about that. Influential CEOs such as Elon Musk and Jamie Dimon. Of course, Elon Musk is very famous for Tesla and SpaceX and his recent desire to acquire Twitter. Jamie Dimon is the CEO from JP Morgan, which is the biggest bank in the US. They came out with some real concerning statements about the future of the economy. Other FOMC voting members also made statements that have concerns about the economy going forward. So taking all those things together, it added a real negative backdrop to the overall market. The economic data that we've been receiving lately suggests that, okay, the economy's still doing well. We're still seeing advances, but they're not going up as much as they were before. And we may be starting to feel the strains economically of inflation as well as the supply chain issues that have been going on. Earnings from a lot of big companies really impacted the market, and specifically, they were negative. Where in the previous week, the retail earnings, that really boosted things up. This past week, we saw more negative reaction to that. Now, on Thursday, there was an exception. Microsoft came out to suggest that their earnings will be lowered in the future. The market initially was very negative, but then ended up bouncing up off of that, and we had a pretty solid day. Our technical picture, specifically on the weekly charts, is still negative overall. We ended up being down 1.2% for the week. Volume was below average, and we're seeing that on the daily charts pretty much every day. There was one day on May 31st, since that was the last trading day of the month, where we saw a real volume spike. But all the other days are below average, and so for the week, we ended up being below average as well. The markets are really fixated on technicals right now. We have a negative technical picture. It's improving quite a bit on the daily chart, and there are even some positive things developing. But we're not really seeing those things that looked positive a week ago on the weekly charts looking as positive right now. Of course, we have inflation and interest rates, which are the real concerns. Geopolitical concerns all over the place. Russia, Ukraine being at the top of the list. And things could develop there at any time, either on a positive or negative basis. The supply chain issues that we're having largely go back to China. Well, they're starting to lessen their lockdowns right now, so that could be improving. Oil is just going up and up and up. We have different Fed speak and policy that I referred to a moment ago, and then earnings as they are released. The condition of our trend on the weekly chart is still negative overall, and I'll have a chart to show you that. Here's a look going back over the last number of trading sessions. You see right here, here's Tuesday, May 31st, where we gapped lower and then spent the rest of the day recuperating, at least for a while, but then we dropped back down. That was a fairly positive day. Wednesday saw a really solid move down at the open, but then we were able to bounce back. Thursday, this is when Microsoft made their announcement. We gapped lower, set a base, and then spent the rest of the day just shooting higher, and we closed right at the high. That was by far the most positive day of the week. And it looked like, okay, maybe things are starting to reverse here. Maybe they're going to look a little bit better. Well, then on Friday, we ended up gapping lower. We didn't move a lot after the open. We gapped below the pivot, came down, danced along S1, and closed right at S1. But we were down strong on Friday, and that added to some negativity for the week. We had been positive on the week after Thursday, while we switched back to negative on the week after Friday. For the week, the Dow was down 0.9%, the Nasdaq down 1%, the S&P down about 1.2%, and the small caps, Russell. They performed better than the other averages, and we're keeping an eye on that for some reasons that I'll bring out in the video. They were down 0.3%. Here's a look just going back 4 trading days. So this is going to look a little bit different than some of the other statistics that you see, where the small caps were actually up over the 4 days that we traded last week. The mid caps were up slightly, but all the other indexes going to the biggies, they were down overall. Looking at our sectors for the week, healthcare had the weakest week, being down 3.13%. Real estate, the financial sector, staples, utilities, tech, communication, they were all down 1% to even well over 1%. There was only one sector at the very bottom that ended up being up on the week, and that was energy, and that's largely due to the real increase in oil. Looking at the different sectors on how they performed over the week, we had energy performing the best, followed by industrials. They were up, and materials. Utilities were up slightly on the week. All of the rest of the sectors ended up being down, with healthcare having the weakest performance of the week. Going in and looking at current market valuation, and this is one of the reasons why the video's a little later. I could have recorded this about 12 hours before I did, but they didn't update the current market valuation chart, so I had to wait for those. Current market valuation is still rating the overall market as fairly valued. And we saw a little bit of a change. The yield curve hasn't changed. That's fairly valued, where the chart continues to come down. This is what changed. We were fairly valued with the Buffett indicator. Well, it's now switched back to overvalued. The price earnings ratio stayed at being overvalued. Even though we had been extreme, we're coming back down off of that. Interest rates continue to be fairly valued, as does margin debt, and we're still overvalued when we compare the current price of the S&P with its mean price. Looking at sentiment after Friday's session, we are in fear territory, and we're kind of on the border between fear and extreme fear, and that could be positive for the markets because we use this as a contrary indicator. When everybody's feeling one way, we want to look at doing the opposite of that. Here's a historical chart which shows we were down below 25 for a long time. Typically, we will come down and spike below, and that's some sort of capitulation or fear, and then we bounce up out of that. Well, we've been camping down below 25 for a long time. We were finally able to get back above that, but we could easily come back down if we have some down days. The Ridex bear bull ratio was updated, and it had spiked up at 0.21. It's still very high, but it did come down to 0.19. In the latest reading, the weekly survey of individual investors shows that they're getting back to being more neutral. They had been extreme negative for quite a while, but in the latest reading, they showed some improvement. We're still below zero, so they're still slightly negative, but when we really pay attention to this is when we have extreme positive readings or extreme negative readings. The VIX is declining on a weekly basis based on the line chart, and we see a series of lower bars on the bar chart. It's still pretty high, but we did drop down below 25. But for myself, I take a notice of this when we drop below 20. The Ulcer Index is still showing on a weekly basis an increase in fear, where on the daily chart, we're back more to neutral. Another thing we like to look at is when the lines are below this black line, that means that everything is okay according to this chart economically. It's when we spike up above that, that's when we start to see a real concern. So yeah, it's going up and has been going up for a while now, but we're still below the black line. This chart measures the difference between risky loans and non-risky loans. When we see a spike up, that means there's great concern. And this has actually been declining slightly lately. During the past week, we have active asset managers. They could be running a hedge fund or a mutual fund or some kind of a fund where they go out and they have the freedom to pick investments. They can switch from one investment to another. Unlike a passive fund where you can only invest in the S&P 500 or the Dow or the NASDAQ or whatever's inside that index. Well, these folks tend to overreact as well. When we were going down, that they had a really extreme negative reaction. And we can use that as a contrary indicator. Even though these folks are very knowledgeable and this is their job, they're human beings too. They were showing extreme fear. We saw a bit of a bounce in the previous week and a slight improvement in this past week. And then down below is the S&P 500. Another chart from Isabel Net. For the first time in a while, we're seeing inflows into stocks that go into mutual funds as well as ETFs, where it had been negative. That could be positive for the market. Since people are feeling a little bit better about things, they're willing to put more money into the market. But it's not a real strong reading now, but at least it is positive. Another thing that is also positive is we see the insider transaction ratio. When we're above this line, that is bearish. When we're below this line at a reading of 6, that could be bullish for the market. Looking at some earnings and valuations, I just have a headline here. There wasn't really a useful chart that went with this. This is a blog post from FactSet where it says analysts are lowering EPS estimates for the second quarter of 2022. That's right now. But they're not lowering their estimates for the second half of 2022. Another thing is Morgan Stanley came out with what they think the earnings estimates will be. Their columns here that are dark blue, this is Morgan Stanley, where this is their estimate. This is the consensus. This is what the rest of the market thinks. So they're a bit lower than everybody else. And then going into 2023, Morgan Stanley is still below what the consensus estimates are currently. Another thing to look at is the earnings per share. This comes out from Goldman Sachs, where they are seeing that the S&P should end up finishing 2022 at about 4,300. Down below, this shows their earning estimates as well, and they do see earnings climbing. Looking at some economic things, the GDP Now chart was updated at the Fed's website, and this just shows that they are predicting for the second quarter right now that we will have positive growth at 2.61. Now, this is an estimate. They're just forecasting this. The preliminary reading that we received showed that we had negative GDP. Another thing that suggests that the economy is still hanging in there is this red line, temporary help services, and the blue line is GDP. Other times when we saw a real decline in employment, whether it's full-time or temporary, this line really dropped down, and then the shaded area is a recession. That happened back in 2001. It happened back during the financial crisis. It happened during the COVID plunge, but that didn't last very long. But look at where we're at right now. So this is suggesting from an employment standpoint that the economy is hanging in there and may not be headed to a recession. Another thing is the probability of a recession that's calculated by the yield curve. And if you look back over time, this goes back to 1960, we see a real spike up in the yield curve, and then we go into a recession. A spike up in the 70s, a spike up in the 80s. Let's go to the more current time where we saw a real spike up and then a recession came shortly after that. We have seen a real spike up after the COVID plunge, but then we've still been coming down, and this is their forecast right now that we are going to continue to fall. So that would also suggest that the probability of a recession is lowering as well. Looking at the Fed, there's a 97.4% chance that we will be at 1.25 to 1.5 after the June 15th meeting. And here's the historical chart that you may find interesting. Then at the July 27th meeting, there's a 90% chance that we will be at 1 3/4 to 2% after that meeting. And here's the corresponding historical chart of how that's changed over time. The Fed balance sheet, it looks like their tapering is kicking into gear. We saw a decline of over $31 billion in the previous video. Well, this last week, we also saw a decline of over $30 billion. And that's what they said they were going to do. They were going to start lowering this by about $30 billion per week. Another thing that we're watching on the daily charts is the 2-year yield. Sometimes when that spikes up and then comes back down, that can lead to a really solid short-term upward movement with the S&P. This is showing how the 2-year yield has really been going up, but it's way underneath the Fed funds rate. And going back, you can see where these two tend to move more hand in hand with each other. And sometimes when it gets out of whack, something will have to change. Either the interest rate is going to have to come back down or the Fed's going to have to raise their interest rates. And that's not happening necessarily any day now. So we just want to keep an eye on this. Another thing, since a lot of you listening to these videos really enjoy investing and trading in stocks like Apple, Amazon, Facebook, Google, Netflix, Tesla, those are the biggies. They have a lot of volume, they have a lot of options, they have a lot of different strategies that you can implement with them. Well, as the balance sheet was going up, that's the dark line, the big name tech stocks were also going up. We've been seeing where a lot of the tech stocks are coming down, and the forecast is for the Fed balance sheet to be coming down as well. They call it central bank liquidity. So does that mean that tech is going to have a lot of trouble ahead? Let's look at breadth for the week. Didn't see much of an improvement. We're still above the moving average based on price, and we also saw a decline below the moving average based on volume. Our advanced decline ratio has dropped below 0. It had been above 0 last week. Well, this is looking more negative. The new highs and new lows, this is a little bit of hope. We're seeing this on the daily chart too. We're seeing an advance of new highs, both with the 4-period moving average and the 10. Accumulation distribution is still negative and below a declining moving average, so that is more negative. Looking at our trend, our ADX is going higher, and the red line's on top even though it's been declining, and so we are in a negative trend. Now on the daily chart, we're just getting close to possibly crossing positive on the ADX. We're also in danger of dropping below 20 and could be in a trendless environment for a period of time. Our Arun is pretty much flat, saw a bit of a decrease with the selling, a bit of a decrease in the buying, so overall we didn't see a real change with the Arun indicator. The mass index, it has generated a signal on the daily chart. We're still waiting for it to fall below this dashed red line for a signal to be generated on this chart. Longer term, the decision point scorecard, they switched after Tuesday's session to having an upward trend in the short term. They switched the previous Friday to having an uptrend with their PMO. The other trends that they measure, specifically the long term, are still negative. Our pivot points, we were able to get back above S1 right now, so that's slightly positive even though we had a down week. We climbed above this in the previous week only to see a bit of a decline, but we're still hanging in there with this support level. If you look down at the bottom, you see that volume for the week was really below average. You have a lot of confused folks right now that really don't know what to do. And if you think about it, that makes sense. If you had 10, 50, 100, $1 million and you were looking to deploy that into the markets, would you do that right now? We are negative when we look at a weekly chart of the S&P because we are below the 50-period simple moving average. And there's roughly 50 weeks in a year. There's really 52, but I just use a 50-period moving average. Our long-term trend is also negative, and you're going to hear a lot of repetition here. We have a death cross, and we are below both of the moving averages. The bullish percent index, it hung in there. Even on some down days on the daily charts, it showed a slight advance. Well, we saw a bit of an advance in the weekly chart, and that is positive, and that's deeper under the surface. The Chaikin oscillator, after giving us a really extreme negative reading, is bouncing back up. and that could be positive. The Chaikin money flow is still negative overall, but we see this moving average is turning up slightly. The Force Index showed a little bit of a decline in the past week, and we are below zero. The McClellan Oscillator, after giving us an extreme positive reading, it's still positive because it's above zero, but it is now declining. The Summation Index is slightly positive based on price, and we're a little more comfortably positive based on volume because we're above zero on both charts. Our oscillators on the daily charts, they're all positive. They're starting to turn more positive on these charts, but still negative overall. The PMO, which is negative, based on price, showing a little bit of an improvement as well as with volume. The PMOs that are rising, after giving us an extreme positive reading, we're coming back down. The buy signals are into extreme positive territory, and we're seeing a bit of an improvement with those that are above zero. So this is suggesting a little more strength. Relative Strength Index saw a bit of a decline in the past week. Special K is still positive, but starting to roll over. On the daily chart, it's negative and starting to curl up. Swinland Trading Oscillator, giving us an extreme positive reading based on price and volume. Stochc RSI had gone a little bit above this dash line, which means that it's more positive. Well, we dropped slightly below that in the past week. Williams percent R also saw a bit of a decline. Vortex, even though we saw selling pressure decrease, the red line is still on top, so that's negative. And we saw an increase in buying power, but they have not crossed yet. Ultimate Oscillator ticked down ever so slightly in the past week. The money flow indicator is starting to go extreme negative. The percent B, based on the Bollinger Bands, this is when we get outside of the bands because we're in a really fast-moving market. It's pretty much neutral in that regard, but it's a little bit more negative since we ticked down in the previous week. KST, which has not really helped us, it's still showing an overall downtrend. The price percentage oscillator, kind of the same thing, but it is more negative, although it seems to be flattening out a bit. Rate of change going back 1 week, we're below the dashed line. That just shows that we were down on the week. Going back a year, we're trying to show a bit of an improvement, but we're still below this dashed line. The Kopit curve, it's turning up and has generated a signal on the daily charts where it's more flat to even declining slightly on the weekly chart. Looking at some fib levels where a few weeks back we came right down to this 38.2% retracement and bounced up off of that, we're still above that level. So this is hanging in there even though we have a down bar for the week. Looking at some different charts, the Heiken Ashi is still showing an open candle. That's a little bit more positive, where the Kegi is more negative since it's red. Renko is also negative with the 2 red boxes. No signals on the point and figure chart, no X's or O's drawn in. The 3-line break also added an open candle, so that's more positive. Our different trading systems, looking at the Elder Impulse system, we continue to be neutral with the S&P. And our SAR, the dots are above, so on a weekly basis we are negative, where on the daily charts we are still positive. The broad market, here's just the S&P, just a blank chart with no studies on here, just to give a visual reference of how these have been performing. All stocks declined slightly and are in an overall downtrend. Mid caps, here's where you're going to hear a lot of the repetition. Death cross, downtrend, possibly coming back up to the 13-period moving average. Same thing with the small caps here. Looking at the Dow, see a lot of real similarities here. The NASDAQ, although it's looking a bit weaker and is further away from the 13-period moving average, as is the NASDAQ 100. NYSE hanging in there a little bit better, and the Wilshire. It's also looking a bit more negative than the NYSE. The FANG stocks, they ended up being virtually unchanged on the week. ARC Innovation had another difficult week. Going back and looking at the broad market, some other markets outside of stocks, commodities continue to be in an overall uptrend. Gold after coming down below the 200-day moving average, is now slightly above it. Silver is a little bit more negative, where we're below the moving averages. We saw a death cross. It looked like we were crossing over positive. Well, that seems to be breaking down currently. Oil, this is what's really been going up. We're at 118.87. We had been higher than this before, but this is still very high, and I'm sure you're feeling that at the pump. This goes back and looks at when we saw a spike in oil prices before. Going back to 1900, we saw a spike in oil prices during World War I. Imagine that. Then, in the 1940s, there was the Israel-Arab War, and there was also an oil embargo. The prices really spiked up at that time. Then we had the old energy crunch of the 70s. And if you grew up in the 70s like I did, you remember this very well. One in 73, another one in 79. Then we had the dot-com bubble, which saw a real spike in oil prices. Here's the great financial crisis. That saw a real spike, and here's where we are right now. When you compare this to other major events that have happened, they've been quite negative. The dollar, after really seeing a lot of strength, has fallen back, even though on the week we did bounce back. We're still in an overall uptrend on the weekly chart. We're still in an uptrend on the daily chart too. It could really help stocks a bit more if the dollar was to decline. The stock market likes a weaker dollar. It makes their books look better, and it gives them more advantages as far as imports and exports. I just wanted to show Bitcoin. It's been floundering around a little bit above, a little bit below 30. This is a daily chart. And I put this text on the screen well over a year ago when I did a video about this. This just shows you some classic head and shoulders pattern formations. And we have big patterns and we have small head and shoulder patterns within the bigger pattern itself. So this just gives you a good representation of what it looks like. And then I ran across kind of an interesting chart that I'm going to start following. This is the total market cap for cryptos. And back in November, we topped out at about 2.9 trillion in market cap. As of Saturday, June 4th, we're down to 1.2. Everybody is more focused on Bitcoin, and that's the one I watch the most. But a lot of the other cryptos underneath that aren't as well known, they're falling even more, and we had a couple even go under recently. Looking at some relative studies, comparing bonds with the SPY just shows that bonds have been really underperforming. We saw what could have been a breakout recently, but that is now coming back down. This is a monthly chart showing, even though we've been having trouble with stocks, they still have been performing better than bonds. We're seeing a bit of a breakout with stocks compared to bonds. We were able to see a breakout not too long ago if we go back to a high set in the year 2000. Intermarket analysis chart shows how oil has been performing the best, and then you have the dollar, then gold, and then those that have been underwater since the beginning of the year are stocks and bonds. The gold to the US dollar ratio is still showing that gold bounced up a little bit, but the dollar's had a lot of recent strength that pushed this down. But now we're seeing gold not really doing much and the dollar having some recent weakness, so that's helping this overall ratio. Gold to the S&P, it's showing some recent weakness. We're coming back down to the moving average. Can we bounce up off of that? Will gold start to outperform stocks again, or are we going to see continued weakness? Looking at the low volatility stocks, which really underperform as the stock market was going up, well, for 2022, they've been outperforming, but lately we have been seeing a bit of a pullback. Growth and value. Growth was the place to be. That's when the market's really going up. That's when the big companies are everybody's favorite. Well, when we entered 2022, that all changed, and we're seeing growth really underperforming, even though it blipped up slightly in the past week. The NASDAQ 100, the 100 biggest stocks on the NASDAQ, they've been underperforming the S&P itself, but we've seen a recent bounce, just a tiny bounce. The biggest stocks in the S&P 500 is called the S&P 100. That's a separate index, and they've been underperforming the S&P 500, but we saw a bit of a bounce in the previous week. Discretionary, the things that you like to have that make life more fun, against staples, the things that you have to have. Discretionary has really been underperforming, but lately has been showing some strength relative to staples. Energy against tech. Energy was really underperforming tech there for a long time. Now, energy has been the place to be for 2022. So what's our outlook for the upcoming week? The economic report's coming out. Big one. We have the trade balance and consumer credit on Tuesday. And then we don't really have anything major until Friday. And this is major. We're going to get the CPI as well as the preliminary reading for consumer sentiment. Things to watch, the technicals on the weekly charts, they're still more negative. We still have some pockets of positive things on the daily charts, but until the daily charts look more positive, the weekly charts aren't really going to show much improvement. The markets are fixated on inflation and interest rates, which is producing a lot of growth concerns right now. We have all the different geopolitical concerns, specifically Russia, Ukraine. In China, they are lessening the lockdowns, and that could be helping the supply chain issues. Oil is just continuing to skyrocket. Fed speak, it was looking like maybe they were going to entertain the idea of delaying interest rates this fall. Well, now they've been walking that back. And so we're paying attention to when folks in the Fed speak, and that bleeds over into the policy that they actually follow. Earnings, as they come out from different companies. Some days it might be positive, other days it might be negative. And then there's a longer term scenario that's happening in Japan that I really haven't addressed in any videos yet. I'm doing more research on that, and I should report on that in the near future. So what are our different scenarios? We are still down overall. And these are the scenarios for Monday. That's as far out as I can go, where because of all the things that I just mentioned, in addition to this recent trend of selling into strength, that could help push prices down further. If we see a bounce and then we see selling after that. The technicals are still negative, but on the daily charts, they're starting to look better. What could help us go up from here? There's the improving technical picture, and sentiment is still negative. It's not extreme, but it's still showing an awful lot of fear. The positive possible scenarios. And watch the daily videos if you want more of a description of these. We have the Copic Curve, Pring Bottom Fisher, and the Mass Index. They've all triggered signals. The Copic Curve and the Mass Index doesn't tell us the direction. It just says something big could be happening. Where the Pring Bottom Fisher, just like its name, it is pretty good at picking lows in the market. And we're seeing signals across all of those right now. The staple spike is also looking really good. We show a ratio between the staples and the S&P, and when that spikes and starts coming down, that is often marked a low in the S&P. We're still a bit confused about 2-year yields. Have they topped like the chart that I showed earlier? Yeah, there's a reason for the 2-year yield to start coming down, but look at what's happening economically. Maybe interest rates still need to go up. And then this Fed pivot that we had been talking about, the technicals are still negative overall. On the daily charts, we have different pivot levels, short-term moving averages, fib retracements that I did point out here, and then other levels that we've hit could act as either support or resistance. And then we're not in a sideways trend because the ADX is still negative and well above 20 on the weekly chart, but it might be changing on the daily chart. So thank you. Have a very good week. Please feel free to tune in to the daily videos. A week ago, I also posted a supplemental video where I go into what's going on with the Fed. And I have a video there and then an addendum that I also did as an update.